Hello, welcome back. This is Steven Yi, and today I'm going to share you some great data to show you why the housing market is still very resilient and things are not as bad as you think. And I'm going to talk about the lock-in effect. I will share with you why the lack of inventory will persist for a long time to come, given the demand. And so it's all about data, right? When you get the credible data in your possession, when you get informed, when you get educated, you can become a very well informed primary home buyer or real estate investor for that matter. Again, do not succumb to all those negative headlines, especially headlines come from the housing crash bros, doomers out there that are using very misleading data to mislead the public about the housing market. So I'm going to use data from Morgan Stanley article 2 days ago, and there are also documented by Mr. Lance Lambert of Resi Club, his organization, his website is up and coming housing data information gathering websites, which is really good. Without further ado, let's dive into what Morgan Stanley has said about the U.S. homeowners or the quote unquote strong hands. Wow, another buzzword in this volatile housing market that we are going through in the past few years during the pandemic and post pandemic. According to Morgan Stanley, the term strong hands refers to investors or market participants who have the financial capacity and confidence to hold onto an asset for a long period of time. This sentence applies to a 30-year fixed rate mortgage. Today, 30-year fixed rate mortgage, especially the one that have a historically low mortgage, these are not debt. These are assets. These are wealth building tools. Okay. So contrary to what we've been hear about all throughout the years, your 30-year fixed rate mortgage, especially with a very low interest rate, is a ticket to your financial freedom. Let me dive into it. Of course, I talked about this a number of times during other YouTube videos. Okay. So analysts at Morgan Stanley continue to argue that US homeowners are the quote strong hands, end quote, this cycle. Okay. Even with the historic housing affordability crisis that we are experiencing currently, that are not affecting to current mortgage holders. And also, the national home prices are more or less unscathed. Unscathed means it has not, the home prices, even in the past few years, still are very stabilized. It has not caused any kind of challenge situation. Okay. Because one of the biggest reasons why is the lock in effect. I know some of you, many of you already heard what this means, but I would like to reiterate once again what the definition of lock in effect and how it's going to impact the housing market, not only for the next few years, but for the next decade and beyond. So let me elaborate on that. So just sit tight. The current mortgage homeowners have a locked in low historic fixed rate mortgage, lowest in history. And as a result, the current homeowners, they simply are dising them from listing their homes for sale, right? Why? Right? Why sell their homes at a low historic mortgage rate to move up to buy a new home? The mortgage rate of around 7%, you'll essentially more than double the mortgage payments. Again, people are just not going to do it. They can sit tight. They can be sitting pretty. As a matter of fact, sitting pretty should be and could be my thumbnail title for my video. Sitting pretty, my dear. You know who said that? That's the wicked witch of the West in The Wizard of Oz, right? 1939 movie starring Judy Garland. Yes, title of this article, I just made it up spontaneously. Sitting pretty. Who is sitting pretty? The current homeowners, okay, who are sitting, who have a locking effect because they have such a low mortgage payment. They have achieved substantial equity in their homes. Right now, the home equity are at an all-time historic high. That's right. People have Current homeowners have more equity than ever in the history of America. They are sitting pretty. They are locked into the historical mortgage rate for the next 27 years. So they're not going to give up their house. They're not going to sell. That's why we are still going through today, right now, as we speak, around July of 2024. We still have a very low inventory environment, and we still have pent up demand. So think about it. Economics 101 is that if demand is greater than supply, we will have upward pressure on home prices. And we are still experiencing in this current environment because according to Redfin, the number of months of supply of homes stands at 3.6% supply of inventory, still a very low inventory environment. As a result, this is still a seller's market. Nationwide, that is, there are certain sub-markets that are having a lot of inventories, especially in Florida and Texas, to name a few. But the majority of the nation still have a low inventory supply situation due to the lack of homes for sale, especially resale homes. And most people, like I said, as this article I'm trying to share is such that they are not going to sell because they have a lock-in effect. They have such a low rate mortgage and low mortgage payments, so they can sit pretty and they're going to hold their home forever. So causing a systematic low inventory environment for a very long time to come. So there are three charts I'm going to share with you will back up this argument according to the article by Morgan Stanley. And first, 39% of U.S. homeowners are mortgage free. They don't even have the mortgage, debt free, sitting on the massive amount of equity of their homes. Okay. And if you can see, since we are after the aftermath of the housing crash back in 2008, starting 2010, even back then, 32% of all the mortgage holders back then, 2010, 15 years ago, 14 years ago, they do not have a mortgage. Then, as you can see, on an annual basis, pretty much each year subsequent to 2010, the percentage of mortgage holders who does not have a mortgage increased approximately 1% more on a year over year. So from 2010 to 2022, we have from 32% of the mortgage holders does not have a mortgage, all the way up to 38.5% in 2022. And I would guess in 2024, this year, the percentage of mortgage-free homeowner is probably around 40%. Okay, so just take that number. Furthermore, among U.S. homeowners who have mortgages, 90% have a fixed rate mortgage. That is why there are little stress in the housing market, right? Only 4% of people have adjustable rate mortgage today, right? Those are the higher risk products. All right. So we have very well qualified homeowners who have very high credit score, very good financial foundation. They are the ones that are currently homeowners. They are the ones that currently have those great mortgages and own homes. So whereas back in 2008 housing crash, around 80% of U.S. mortgages were subprime mortgages, were adjustable rate mortgages. That's why the housing crash back in 2008 due to the subprime mortgage crisis. And now is a completely different scenario. So there are no correlation based on this important data I just shared with you between the 2008 housing crash versus today's 2024 robust, very stabilized housing market condition. All right. And if we compare this chart clearly, and I talked about this before, look, American consumers, we are spoiled. Our housing market is so stable compared to the other developed countries of the world. And we, as you can see, we have highest percentage of the very low risk 30-year fixed rate mortgage than the rest of the developed countries. Look at this. Finland, Australia, Ireland, Sweden, Italy, UK, Canada, Germany, and France. You could make an argument, these developed countries, their quality of life, their economic situation are very similar to the US, if not better for that matter. And yet, look at the percent, look at their most of their mortgage rates, mortgage products associated with homeowners from those countries, they don't have a 3-year fixed rate mortgage. They have either variable rate up to a 1-year fixed. They have a short-term fixed rate, 1 year to 5-year fixed. They have a medium-term fixed, 5 to 10 year, and very few, if any, have a long-term fixed that for more than 10 years. And we in the U.S. have 96.4% of 30-year fixed rate mortgage. This is the ticket to your financial freedom. U.S., come on. American dream, definitely, if you're a homeowner, either currently or about to be one, you are buying the ticket to the American dream. Again, if you qualify to buy a home to live in, if you have a long-term perspective, you have a good financial background, then do it. Buy your house. As a risk investor, it's never the wrong time to buy a rental property as long as you have good credit, you have a down payment, you buy in a good cash flow markets in the rural areas, which what we do is my business, help mom and pop turnkey investors to buy cash flow properties in the lowest entry level homes in the US, mainly in the Midwest and South and Southeast. All right, getting back to this article, among the US homeowners who have a mortgage, 76% have an interest rate below 5%. Okay, look at this. Look at the breakdown of people between 3% to 6%. The majority, 70%, have mortgage rate below 5%. And look at this. Almost 22% of the current mortgage holders have 30-year fixed rate mortgage below 3%. Oh my goodness. These homeowners have no incentive to sell their home. It just doesn't make any point to do that because they've locked in for such a historic no mortgage rate, no mortgage payment. Even if they go through a lot of stressful situation, they can always sell their home. They can always rent their home for renter. There are many mitigating way to save their home because not only they have no mortgage payment, but they have substantial equity. Many of them, not all, would own their houses. Okay, and here's a further breakdown. Right, 35% of people have mortgage rate from 3.99%. 18.7% of mortgage holders have a mortgage 30-year fixed rate debt is 4 to 4.99%. 9.6 of mortgage holders have rates between 5 to 5.99, and 14% of mortgage holders have mortgage rate at 6%. And this category of people most likely bought their home in the last 18 months on the high interest rate environment. Nothing wrong with that. So the highest risk of people are in this category. If any kind of financial stress come upon these people in this particular category, yeah, they would be a higher risk of default because for whatever reason, okay? And the people below a 6% mortgage, they are at a lowest risk of default for the reasons I just stated. All right, let's continue. Because of the lack of homeowner stress, by the way, when there are no stress, homeowners, you're not gonna have a housing crash. That is such a simple, fundamental aspect of economics 101, right? When you have low stress environment, you're not gonna have distressed sales, as indicated here. So as a result, the absence of distressed sales, foreclosures could be one reason national home prices remain stable despite mortgage rates doubling in the past few years. Okay, see, the housing market is very resilient, and the cost of money has tripled since 2021, and yet the housing market, housing prices are still very stabilized, with a certain minor exception in several markets in the US. They're going through some little bit of correction. All right. Anyway, let's see what else. As I conclude this, now on the other hand, on the other end of the spectrum, it says right here, we should also note that while US homeowners at large might be less vulnerable to spike interest rates, US credit card borrowers with variable rates haven't been so lucky. Indeed, credit card stress and delinquencies continue to rise. Look, these category of people, I hate to say this, is a reality. These people are going through some credit card situation. They are most likely not homeowners. They're most likely are renters who are one paycheck away from financial catastrophe, if you will. That's how it is, right? The difference between homeowners versus renters, non-homeowners, that is, So a lot of people in this category who are overspending on this and that. It's not just happening today on a historical basis. Renters, non-homeowners, for the most part, based on clear-cut historical study, they have higher risk of default because they have a no backup plan. They don't have a home. They don't have an equity to hold them over if they get into some other financial crisis, such as high credit card stress. So the crux of this article is such that we have a lock-in effect, and people at the resale homes or just sitting in the market. So we still have a low inventory environment, low housing supply environment, and there's still a lot of demands out there, even though the mortgage rate right now is around 6.83%, according to the Mortgage News Daily, updated July the 20th, today, 2024. Yeah, so that's pretty much it. The lock-in effect, and everything else will continue to persist. I believe that furthermore, there are, according to some sources, that we are still short anywhere from 4 to 8 million of homes. Shortage of homes. Okay, that's been around for a while. It's still a seller's market, right? The supply, the monthly supply of the inventory, according to Redfin, the last data last week, still indicates a 3.6 month supply of inventory, still below the normal, right? Still at a very low rates, because of the lock-in effect, right? That's what happened. This is the new normal. The new normal is such that it's very hard for supply to catch up with demand or inventory, and so we can actually see a seller's market for a number of years to come. That's my prediction. Housing market is very resilient, and the winners clearly in this market are the current homeowners who are sitting on their amazing historical low mortgage fixed rate 30-year debts. They have a ticket to financial freedom. All right. So with that said, thank you for watching. If you receive any value whatsoever from this video, please like and subscribe to my YouTube channel, and also put your email into my website below so you could become a free member of our investment network, so you can receive daily free real estate investing opportunity and education right into your email inbox, so you can potentially become a real estate investor and achieve your financial freedom that way as well. All right. Thank you so much. This is T. Wayne Yi. I'll see you on the next video. Bye-bye.